Hello students, my name is Gaurav Bansal and we are going to discuss something very interesting about the Indian accounting system today. So it is that time of the year when budget is about to come, and as the budget will come, lot of articles will be there in the newspaper covering the terminology, covering the budget schemes, covering the grants, etc. But today we are starting with a topic where we understand the basic accounting system of India. What is the system within which the budget also operates? All of you, as you are preparing for UPSC in most cases, have heard or are aware of that budget is technically not even called budget in India. It is called annual financial statement under the Article 112 of the Constitution. I'm sure everybody is aware of that. So, what statement it is? अगर budget annual financial statement है, if the budget is annual financial statement, what type of a statement is that? That is something we need to understand. So, to be short, budget is actually a statement of Consolidated Fund of India. But along with budget, a statement of Public Account of India is also given. So let us discuss the accounting scheme and the three systems: the Consolidated Fund of India, the Public Account of India, and the Contingency Fund of India. Generally, these topics are taught in polity, but when we study them in polity, the perspective is a little different, and hardly we ever cover them in economics. So I'm trying to cover the both perspectives here. Now, let us look at it. So, as we are aware, there are three accounts that are maintained: Consolidated Fund of India, Public Account of India, and Contingency Fund of India. Okay? And these are accounts which are also audited by the CAG, Controller and Auditor General of India. Now, let us look at these three one by one. First of all, we look at the Consolidated Fund of India. So, you can consider Consolidated Fund to be almost like a treasury. I'm sure you have heard the word treasury a lot, or sometimes we hear this word in the newspapers, or we in the news channels, or we read sometimes that something is called Sarkari Khajana. What is that Sarkari Khajana? It is basically this Consolidated Fund of India, which is almost like a Sarkari Khajana, which is not a correct word because Constitution has given us this word, Consolidated Fund of India. So it is almost like the treasury. Okay. Now, what is that? How does it operate? What are the rules? Let us look at it. So, as per the political background, it is under the Article 266 1 of the Constitution. Basic factual information. Now, the most important point is all the revenue of government are added to Consolidated Fund. Whatever government earn, whether it is tax, so all the tax revenue, whether it is from income tax, GST, corporate tax, or any other tax, that will be added to Consolidated Fund of India in case of central government. Okay? And similarly, all the non-tax revenue. In the non-tax revenue, we have profits from PSU or dividends from PSU. Okay, we have some of the other sale income of the government, rental income of the government. All of those are non-tax income. So those are also added to it. And thirdly, even the loans that government take are also added to it. Okay, so all the revenue, income tax, corporate tax, custom, excise, everything is added to this fund. Similarly, all the non-tax revenue, license fee, dividend, profits, as I just said. Then all the loans through treasury bill, internal, external bonds, okay, are added to this fund. Now, why do we use this fund? Where do we use this fund? What we add to this fund is clear, but where do we use? For all the regular government expenditure, we use this fund. All government expenditures are made from this fund. And as per the rules, the government cannot withdraw money from Consolidated Fund of India without prior approval of legislature. Means the Lok Sabha needs to give an approval to the executive that you have my approval to withdraw money, then only executive can withdraw money. This is the limitation on it. And budget is actually an exercise for that. In the budget, we are getting that approval for the entire next year. Whatever government plan to spend in the next year, government gets it advance approval for that, so that the governance is smooth, so that government can continue to work very smoothly without much of interruptions. So consolidated fund is where all the money of government is stored and from where all the expenditure of government is maintained. But you cannot use it, means the government of India cannot use it without approval of the legislature. And that is exactly why we get the budget passed in the parliament. Now, outside budget, if government ever want to withdraw from consolidated fund, then for that we have appropriation bills. Government needs to place separate appropriation bill in the parliament and get approval on that. So there is a very strict provision here. Okay, and as I told earlier, it is audited by the CAG as per the standard principles. And if there is any discrepancy, if there is any discrepancy, if there is any manipulation or any, let us say, misinformation, then a report will be given to Parliament regarding the same. Okay? When accounting standards are not met, then such reports are, and it is maintained by the Ministry of Finance. Now, I hope Consolidated Fund of India is clear. And just like that, the same article of the Constitution, Article 266(1), also creates Consolidated Fund of the states. Now, what is the rule here? The rule is, the point number one is, it exists for each state individually. That means each state will have its own separate consolidated fund. And just like the central government, all the tax revenue, okay, received by the state government will go there, whether it is tax, non-tax, or borrowings. Okay, all of these will go to consolidated fund of the state. This also has to be audited by the CAG. Okay? The rule is that CAG must audit these also. However, the report for that is submitted with the state legislature. Okay, if report is there regarding the consolidated fund of India, it will be submitted to Parliament, and for consolidated fund of state, it will be submitted to the state legislature. So that is how the consolidated fund of the state is operated. And accordingly, the state budgets are also an approval from the state legislature, Vidhan Sabha, to get approval for all the expenditure. So exactly like that, this also operates. Now, Consolidated Fund of India is clear, means that is the core account from which everything is maintained. Then what is Contingency Fund of India? So now let us come to the Contingency Fund of India. So first of all, the constitutional scheme. So it is under the Article 267(1) of the Constitution. Now contingency, the name itself should make it quite clear. Contingency means emergency. So it exists for emergency purposes. It is a reserve that we maintain. Okay? So when there is some emergency, we might use that reserve. So the reserve is maintained in such a manner that a minimum amount is always maintained by the president. So it is placed under the president first of all. It is under disposal of president. President has to take decision when to withdraw money from this, unlike government of India. Okay, or government of India will advise president on this, and president can also make advances. This is a big difference here. Means you do not necessarily have to take prior approval. मतलब यहाँ पहले लोकसभा से परमिशन लेने की रिक्वायरमेंट नहीं है. अगर कोई इमरजेंसी है, आपदा है, तो प्रेसिडेंट इसमें से पैसा निकाल सकते हैं. So if there is an emergency, if there is a disaster, if there is some anything can happen, so then president can order for withdrawal from this fund. However, that withdrawal will later be approved by the parliament. Means they can take only advance. It is not discretion of president entirely. President can ask for withdrawal, but it will be pending the parliamentary authorization. This is very important. Parliament must approve it. President अपनी मर्जी से है, just by their personal wish, president cannot withdraw. That is what we need to understand, and it can be used only for specific purposes. Okay, mostly disaster management. Okay, and approval from legislature is required. Okay, that approval is required. You may not need it before taking the money, you may have to take it after taking the money. So this is regarding the approval. Now CAG audits this also as per the standard procedure. Okay, and same principle is followed here also. Now the major development is this fund was very small. It was only 500 crore before 2021, before the COVID crisis. We didn't increase it for a very long time, and then suddenly at the COVID situation we realized this money was too less. 500 crore for a country like India is not even a peanut. It is just too less. So then in 2021, the corpus, the minimum amount was increased to 30,000 crore. 30,000 crore, you can say, is almost close to $4 billion. Okay, so that much we increased it to. Now, how is that money used? In the consolidated fund, money come from tax revenue, non-tax revenue, etc. Here, how the money will come? So money will be given from consolidated fund. Minimum 30,000 crore rupees will be maintained in contingency fund as per the new requirements, and president can withdraw money from it. But after that, later the money must be recovered from consolidated fund. It must be given from consolidated fund so that minimum 30,000 crore is always maintained. So this is exactly how this fund is maintained. In addition, money that is coming from donations under President Relief Fund, under various other relief programs, Prime Minister Relief Fund, can also be added, can also be used for this purpose. Okay, it is not necessarily part of it. Those accounts are also separately maintained under complete discretion of President or Prime Minister. Okay, they have to just give a report of that. Approval is not required. Okay, but here there is a difference. So the contingency fund is always maintained at a level, and money can be paid mostly out of consolidated fund if required, or otherwise it is paid from various relief funds if there is spare money available there. It is operated by the Ministry of Finance on behalf of the President. So that was about the contingency fund of India. Now contingency fund of the state governments. So exactly like that, under the article 267(2) of the constitution, there is a separate reserve for each state. Okay? We do not have a common reserve, we have a separate reserve for each state, and exactly like consolidated fund of India it is operating. So here also the rule is same. They maintain a minimum amount approved by the state legislature, so it is different for different states. So we do not have to remember a number here specifically. So they maintain a minimum amount which is placed at the disposal of governor. So over there it is president, here it is governor. So governor can order withdrawal from this fund even before legislature gives its approval. Of course, it is pending approval. Okay. So if there is a requirement, they can withdraw, but later on, state legislature must approve it. So now there is almost a repetition of information. So let us go through it quickly. So legislature approval is necessary, okay, as I discussed, and advances are paid back to the fund after the approval. Okay, and it is different in different states, as I just said. Okay, decided by their different legislatures. Now let us move to the public account of India. So what is public account of India? The public account of India is maintained where government is acting as a custodian or banker for people. Technically, it is a liability of government, but this is not the amount that government is borrowing. or using for its individual expenditures. Okay, so now let us simplify it. In the public account of India, all the money that is coming from provident funds, okay, then post office deposits, then different schemes. Okay, for example, Sukanya Smriddhi Yojana, there is a popular scheme. Okay, then there are money coming from various certificates, saving certificates. So there is National Saving Certificate. Okay, then there is multiple other type of such instruments. So all of those are where government is giving people interest and almost acting like a banker to them. So all that money government maintains in a separate account in public account of India. This is not general revenue for government, and government do not use it for day-to-day purposes. This money is reinvested, okay, by PFRDA, Provident Fund, okay, Regulatory Authority. Now that authority uses bulk of this money, not entirely, but bulk of this money, and makes a return on it. Just like a mutual fund manager, they use the money and get return, and through that they pay to people. Now coming back to it, so public money is received in such transactions. Which type of transaction? Where government is banker, okay, provident fund, small savings, deposits, etc. Over there, those money are added to public account of India, and this is as per Article 266(2). Consolidated India Fund of India was Article 266(1), and public account of India is Article 266(2). Okay. Now, what are some of the examples? I've already given you those examples. Okay, provident fund, small savings, etc., and government schemes. And money is needed. Okay, so when people fund mature, so that is the simple idea. It was separated from consolidated fund, or it is separated from consolidated fund because it is not a general revenue. It is not a general money that government is going to use. And this is very important distinction, because in the next video we will discuss the other terminology in the budget. Budget include a lot of documents. Okay, so all those documents, what are they, what is their purpose, what do this address? Okay, all of that we will discuss in the next session, where we talk about multiple other terminologies. So over there we will talk about it again, how maintaining a separate public account is very important, because we use a term public debt. Public debt is not including the public account of India. Public debt is only against the consolidated fund, for example. So we'll look into it in the next session. Meanwhile, let us continue this. Okay, so very important point here is legislative oversight. Okay, unlike the consolidated fund or contingency fund, you do not need legislature approval. There is no requirement for parliament to approve when government can use this money and how government can use this money. This is completely as per government discretion. But as I told, government does not generally use this money. Government invests that money, okay, in multiple other resources, which can be forex reserves, which can be gold, which can be other financial instrument, it can be PSUs which will pay fixed interest on it. So in those ways the public account of India money is used. Okay, so this separation, why separation from consolidated fund is required, is actually clear, because if legislative oversight is not given to this account, it would be very difficult to manage. So it was required that there should not be a parliamentary approval required for this account. So now let us sum up everything. We have completed all of this. Now let us sum up everything. First of all, let us talk about consolidated fund. So I have let us say provided everything in objective manner here. So constitutional basis we have discussed many times, Article 266(1). Nature, it is the main account, the treasury, where government revenue, loans, repayment are consolidated, aggregated. That is why the name consolidated fund. Usage, all government expenditure is incurred. And what is the legislative oversight? Approval is required before getting the money. Every time you want to withdraw money from this, you need Parliament's approval. Okay, and that approval is taken through appropriation bills. And budget is the largest appropriation bill, the annual financial statement. Now, public account. So under Article 266 to nature, it deals with separate transaction where government is banker. Okay. Examples we have discussed a lot. Legislative oversight is it is not subject to the regular legislative votes. Parliamentary approval not required. Next, contingency fund. In the contingency fund, we have established under Article 270, 267(1), and then it is maintained for unforeseen, something which for which you cannot plan, which comes as sudden emergency. For those expenditures, we maintain it. Usage, President can make advances pending parliamentary authorization, and that is also the legislative oversight. That Parliament approval is required, but not in advance. It can be taken even after spending the money. So that is important to remember here. And purpose, how much money is maintained? So it was a recent development when it was made to 30,000 crore, and it used to be only 500 crore before that. So this is where we end this session. Now, these slides will also be available for download in the video link. You can download these slides if you need this for information. And to join my other social media accounts or to get regular notes and updates, you can use these links also. So I hope this video has helped you, and we'll be making multiple parts of it in a series on the budget. Okay. So next topic would be budgetary documents, just like it was accounting system in India. So this is where we end the session. Thank you.